Fascinating subject tonight, crypto custody. I have learnt already just by interviewing some of the panelists. So what I'm going to do is, first of all, Tobin. Tobin Rankin is actually the attorney tonight who's hosting this panel. He's a FinTech guy at Shepherd Mullen, so if anyone wants to run anything by him or talk to him, feel free. And if you leave some cards out on the table, sure, that'd be great, thank you. And so now I'm just going to pass it over to Matthew Lamerle from Peretsu Capital. He's actually going to moderate this panel, and he'll get all the panelists to introduce themselves. Thank you, Matthew.
Great, and thank you very much, Pimo. Thank you very much, all of you, for coming out tonight. And also, thank you everyone who's watching this, either tonight or in the future. It's really a very interesting topic, but it's also a very little understood topic for many people who are in this space. And so I think tonight will be interesting. Our goal is to lay a playing field, a level playing field of knowledge for all of you. I know some of you are experts, some of you are not. The second thing we're going to do is talk a little bit about some of the challenges of applying a custodial framework into a new asset class. And then thirdly, we'll have a little bit of a conversation about the future. And we are joined by three really amazing panelists. We're very fortunate. But in order to make sure they get their best foots forward, I'm going to ask them to self-introduce. So why don't we start at that end, please?
My name is Mason. I'm the CEO of TokenSoft. We basically help issuers that are issuing digital securities on the blockchain comply with banking securities and tax laws at issuance and while their tokens are trading. We, whether that's domestically or on a country-by-country basis, we have some clients that we're helping to enforce securities laws in 56 countries. And so we do operate internationally. I think the reason I'm here is we did build a self-custody solution in-house for digital securities we provide to all our issuers, also a former coworker of Ben's. So that's what we do.
My name is Matt Zimmerman. I'm the CEO of Base Zero, and we're a software vendor, so we build a technology platform that financial institutions can use to get the level of security they need in order to hold crypto assets.
Great, my name is Ben Chen. I am the CTO at BitGo. BitGo is a digital asset financial services company. We've been around since 2013. At the time, we were known mainly for pioneering Bitcoin multi-sig wallets, so security and scalability. We do about 10 to 15% of on-chain global Bitcoin volume. And I think in order to go a bit into custody, our vision has always been to see a world that blockchain could help make financial services make it more efficient, more global, and reduce counterparty risk. And more than a year ago, we decided to take on this challenge of institutional custody because we thought that was one of the largest challenges to enable institutional adoption, which is what we're really about. And so last year we received a trust charter from the South Dakota Division of Banking, allowing us to be a custodian, purpose-built for digital assets.
Great, thank you very much. And for myself, I'll put a few cards on the table. I'm an advisor at Securitize and Bitwise, and investor at Blockchain Capital and Pantera and Castleline and a few others. And my wife is on the boards of First Data and FISO, which are more traditional players, Royal Bank of Scotland and so on. So we have a foot in each side of this conversation. But we're going to begin just to build the base knowledge of everyone in the room by talking about old-fashioned custody. And the first question I want to ask the panelists, and by the way, you don't all have to answer every question if you don't feel like it, but it's a very simple question. What in the traditional world of financial services is custody?
My background's in high tech and software, so I'll keep it brief in talking about the traditional financial world. But custody, even there, is a pretty multifaceted thing. And how do you think about custody and holding a security versus something like gold versus deposit accounts can be quite different when they have both legal and more operational and technical considerations. I think we see that in crypto as well, which we'll get into more later, but that's how I'm coming from it.
Yeah, so I think there's different facets of this. There's there's sort of like the legal definition of custody, and then there's what it actually is. And I think it's important to understand both of those. So in terms of just money or Bitcoin, if I hold if I have a service that's holding your Bitcoin, then and I have the ability to move it around on your behalf and have custody of your funds. And so, for example, when you have money in the bank has custody of your funds. They can theoretically go move it around. They can lose it. They can add to your balance, which will probably never happen, and things like that. Then there's also custody in terms of securities. So now there are shares of a company that you perhaps bought through E-Trade. In the back end, they sit with the custodian, so they don't actually move around. They're sitting in one place with a custodian like State Street. And so whether it's with money, Bitcoin, or digital securities, there always has to exist a custodian that's actually holding these assets.
Yeah, I think that's right. I think traditionally in the traditional world, not many people are actually used to taking custodianship of the assets that they hold. If you're a hedge fund, for example, you don't really want to be setting up your own vault to put the gold in it and maybe store the vault in the office. You wouldn't do that. You would have a custodian for your gold. So I think that's one of the reasons why people ask for, look for custody. The second reason is more compliance and regulatory. And I think for me, at the core of that is that I believe when you have institutions involved and when you're taking care of other people's money, then the standard of care should be higher. So one example is, say, if I were to put my money with some fund in which I'm going to invest in, right? I would want to know that they have my assets stored safely, and that the assets actually are there. So, for example, you don't want to be putting your money with the fund where the fund necessarily takes their own custody, and they tell you, we made 10% month on month. Which could be multisignature, which is actually what Madoff kind of did. He said, I have 10% month on month, and actually you have this amount. And you would love if the custodian could provide you with proof that money is actually there.
Great, thank you. So you mentioned State Street down the end, and I think we know it's one of the world's largest custodians. I can understand why a relatively unsophisticated organization might give custodianship to someone else. You use the gold example. But why would one of the largest and most sophisticated financial institutions ask someone else to be their custodian? Why would that happen?
Well, in some cases, it's a matter of regulatory compliance. And custodial banks are generally, they're not necessarily allowed to engage in other types of banking activity. But there can also be operational reasons, a separation of concerns, in order to focus on their core business.
Okay, that's really good. So just doubling down on that, you say some people hold assets, other people may trade assets. Why wouldn't you have one person be doing both?
Because it doesn't necessarily add value, I think, in the area of traditional financial instruments. I think it's quite different with crypto, and I think that we will see those lines become a bit more blurred because of that.
Okay, so in my head, it's a little bit like the bookkeeper story. You give the check to your bookkeeper, you ask them to manage the books, but you don't give them a signature too, because otherwise they've got everything they need to be fraudulent. So you tend to break these things up so that different people own different pieces of the equation, but no one person has everything in-house. Do you think that's a fair summary, or? Yeah, I see some nodding. All right, so let's keep going. How big is this? There are, I think I just saw $53 trillion of public equities in the world. Is this a multi-billion-dollar business? Is this a multi-trillion-dollar business? How big is traditional custodianship?
Well, I think it's fair to say that it's a large global business. I don't have a lot of figures off the top of my head, but it's a major part of the global financial system and a necessary part that underpins it.
Okay, and is it regulated?
Very much so.
Who by and why?
Depending on the jurisdiction, of course, it varies around the world. But I think there are several reasons why regulation is important in that area, both to protect the customer's assets and ensure that they're not being mishandled, to prevent fraud and so forth, and to ensure the integrity of the financial system to make sure that we have correct information and so forth.
Ben, do you agree with that?
Yeah, I think it goes to the same thing as what I was trying to allude to, which is that when you really need a high standard of care when you're taking care of assets which belong to someone else.
Yes, you did say that. So the people in the room, should they care about traditional assets being properly custodially managed?
I think that they should care, but should they need to care, they shouldn't need to care, right? Like when you use a financial product today, when you buy into some hedge fund or some fund, mutual fund, there's custody going on behind that, but do you really need to know?
Great. Do you want to add anything at the end?
Yeah, I think it's important to note that a lot of the regulations that we have in place came about because something went wrong at some point in time, or there was a concern at some point in time. And so a lot of these regulations are designed to protect people, whether they're investors or they're the companies. There's regulations in place to even denote exactly how people must interact with these securities and these assets. And so I think these generally come from a good place, and I think that we can benefit a lot from just taking the regulations as they are and not trying to build around them or getting too creative, but working with the regulations. And then once we get more comfortable, if we want to look to amend, let's say there's a limitation once this goes mainstream, and I think that's probably the right time to look at changes. But I think for now, I really think for startups in the space, these regulations are there for a reason, and it's probably good to build into them and to use them to our benefit.
Great, thank you very much. So this is a crypto event, and there may even be some crypto anarchists in the room, but there aren't any on the banner because they know custodianship is huge. It's absolutely required in the global financial services industry. It's heavily regulated. It's there because it protects every investor to make sure that other people, intermediaries, and people holding their own assets don't somehow become Madoffs and take advantage of them. And it is an old industry, but it's been technology enabled for quite a while. So now I want to move into the crypto space a bit. And we were having a great conversation before where you actually, in this world of these new assets that are being created, you actually had a classification that you thought might be helpful tonight. So do you want to just share that?
Yeah, so I think with all this stuff, we built some base tech. Like when Bitcoin came about, it was just technology. People started playing around with it. Eventually, people started forming companies around this technology, and that's where they ran into regulations. Once they started working with other businesses in the space, or they wanted to work with banks, and I think so. So for us, when we operate in the space, it's really important for us to look at the tooling from the lens of the regulation versus the other way around. Because if we look at it from the other way around, we're going to look at what's the most convenient, and generally, the things that are most convenient in crypto are illegal. And so when we're looking at custody, we sort of broke out different concepts or different styles of custody, and the reason is that there are different regulations that you have to follow. Or there are different sort of regulatory structures you can undergo and sort of get licenses for, and they enable you to hold different types of assets. So from our lens, there are digital assets, things like Bitcoin, Ethereum. There are also digital securities. Digital assets that are being treated as securities. and that requires different licensing to manage. And so we have the concept of digital assets, digital securities, and then there's the concept of administration for digital securities. And that's generally what a transfer agent would do with public securities, but we really parted that out, and the reason was that the feature sets are very different for the tooling. And so when we operate in our context, we have these three concepts: administration of digital securities, custody of digital securities, and then custody of digital assets. And that's the lens at which we come at it from.
Okay, I think that was very helpful. Does anyone want to build on that? Matt? I think you turned it off. Give it a go, it may be running out of battery. Okay, take this one.
Thanks. I just wanted to build on what Mason was saying about regulation, and that definitely there's a lot of catching up to do, I think, in both directions, both for these newer businesses and asset categories to adapt to the existing regulatory framework that's there for a reason. And also the regulatory framework needs to catch up with some of the newer realities of those asset classes and the way that they're different from what those regulations were designed for. So we'll meet somewhere in the middle, and it's not clear exactly where that'll be yet.
Great, thank you. I just want to give a slightly different framework. I liked yours, but the way I think about it is when we're talking about custodianship for new digital assets, it's both a vertical and a horizontal. And what I mean by that is, as an asset class, we have real estate, public equities, bonds, things like gold. They're all asset categories. And I think there is a new asset class emerging, which is called something, crypto assets. But we also can tokenize any other asset. So you could have a gold-backed token, or you could have a company equity that's been tokenized. And so in that sense, we're also talking about the tokenization of all assets, and you as custodians may need to do both. And I think that's implicit in what you said. There's the custodianship of the vertical, which is the crypto vertical, but there's also the custodianship of all digital tokenized assets, even if they came from traditional categories. I don't know if that's helpful.
I think that's a great way to make that distinction. I think, I've never heard it put out that clearly, but it does describe a little bit about how come some people get confused in a bull market where they think that crypto is a new asset class from an investment point of view, but at the same time there's crypto which is going to modernize finance and change the way that you look at existing stocks and bonds and other asset classes.
Yes, I'm observing, I think a lot of people are now pivoting, which is they were very bullish on the vertical and now they're becoming very bullish on the horizontal, and we have yet to see whether the reality be either. Please, Matt.
If I can, I think that's a great point. It illustrates why I think that we all need to care about how this is evolving, and not only folks who are necessarily dealing directly with crypto assets, but this will be a new way to interact with other types of financial instruments as well. And so it has a much broader scope than just the crypto ecosystem itself.
Yes. So I didn't do a lot of research before coming here, but some of those early opening questions were a little loaded. I do actually believe the traditional custodians handle trillions of dollars of assets, and they are some of the largest and most sophisticated financial entities in the world. And so that then brings us to crypto. We've got this new asset class, maybe $200 million worth of assets. Let's just talk about the vertical. Why is it difficult to act as a custodian in this new asset class? Isn't it just the same as any other asset class?
I think there are challenges on both sides of it. So not only are there a lot of open questions around how to apply regulatory frameworks to this asset class. Also, the technology is very rapidly evolving, and there are new challenges all the time. So to put those two things together, to have a coherent custody strategy, if you don't understand where you stand with regulation, and it's a moving target to keep on top of the market that's evolving and the instruments that are there. That's a difficult hurdle.
Yeah, when we look at it as, we need to get right in order to be a great custodian. You need compliance, you need technology, you need people, you need processes, and you need some physical security. I think the difference for crypto is that, not so much on the people part or the process part. You can still set up people and process, but on technology, it's very different. You need to entirely change, how you would develop a wallet, how would you handle your private keys, and then on the physical side, storing something which can be copied and exfiltrated. In other words, storing a private key which can be removed from a vault is a lot more difficult than a physical piece of gold, where if the gold is there, it's actually physically there. And there's good news and bad news there, right? So you can't split a piece of gold up into 5 different parts and have a different key and require all 5 keys. But with digital assets, you actually can. It's called multi-sig, and it's been very helpful. So on the other hand, once you lose a piece of information, it can be copied without actually someone removing it. And not only that, someone could have copied the private key and lied in waiting for a long time before deciding to obtain it. So there's many other different challenges on the physical side.
So you've used that gold analogy a couple of times, and I get that. I mean, if we were a commodities trader, there might be a warehouse with platinum or copper or barrels of oil somewhere in the world, and a derivatives contract might have been built on that. But for equities and bonds, they're just digital assets. We might issue a share certificate still, but it doesn't have any meaning. It's all just digital. So why are digital crypto assets different from digital public equities?
Right, I think that a big difference between the way that many of the blockchains work and the way that traditionally we've done it is that traditionally we have a ledger, and it's, in the case of digital assets like securities, it really represents the balance of each person. So there is a central authority there that can, if a mistake was made, maybe undo the transaction or change the balances. In the case of digital assets like Bitcoin and Ethereum, once a transaction has occurred, the consensus of the network is such that you cannot undo it unless, of course, you got really creative with a smart contract that made it undoable. That would change a whole lot. But that is it's a very unforgiving but yet powerful new concept of which people can, if they wanted to, take self-custody in such a way that nobody could take the assets away from them. And I think that when we talked about crypto anarchists and all that, I think that I can see it both ways, right? The real value here is that it enables, in my opinion, you to trade and interact globally in a very risk-free way, such that there's no counterparty risk. And the fact that, just because custodians exist, I believe is a little bit like how Gmail exists. When you look at how email works on the internet, it is fairly centralized. You have many domains, but many people choose they don't want to run their own email service, their own domain. I want to use Google or use Hotmail or whatever it is, and they delegated that responsibility to someone else. And the power of the whole system is that you don't have to delegate if you don't want to. You can take the custody if you want, but a lot of people will feel better about having others take custody.
So that was very good, Ben, but I'm going to ask you one of my tough questions that I was going to do at the end, but you've teed up the question, so let me ask it. If you were a custodian for Ether Classic and there was a 51% attack and we rolled back the block and the assets that you're holding vanished, whose responsibility would that be? Is it yours, the custodian, that the assets that I entrusted to you are not immutable and have been eliminated?
I think that's a very interesting question to which the answer will be probably discovered over time. I can tell you that we have been considering that risk, but in a different case. So when we look at many of these tokens on Ethereum, smart contract tokens, Ethereum is built such that the tokens live on top of code, which some developers can write well and some developers may not write well. So you could take the best care as you can of the keys behind them, but if, say, we were to support, and we get a lot of requests to support different types of digital assets all the time, if we were to support a digital asset which itself were the concept of that digital asset were to be hacked, then what happens in that situation? So we, to some level, we have to be careful with that.
Yes, I mean, I would not want to be a custodian of buggy software. Okay, so let's just go back a little bit, because I think we were trying to build the knowledge of the audience. We went through the traditional case. We started talking about crypto. I think we established that for the vertical, there is a need for custodians. We talked a little bit about why it's difficult. And then there is this conversation that we're hearing a lot, which is if the institutions come in, crypto will take off again. However, custodianship is one of the barriers. And I'd like you just to dig into that a little bit more and explain to the audience why the institutional players are on the sidelines waiting for institutional grade custodianship to appear.
Yeah, it's kind of funny when the institutions started coming in, the Bitcoin price actually went down. I think the institutions, they're used to operating in a very rigid environment. They have a lot of processes, a lot of rules. There's a lot of other regulated entities that they interface with that need to exist for them to do their job. And so there's this very complex sort of framework and fabric that's come together over time that's baked very heavily into the regulations on 20 to 30-year-old technology. And so now that we're introducing things like Bitcoin into the mix, completely new technology, there's no best practices for custody, there's no best practices for how to regulate these things. And there's really two challenges that exist. So one, the technology is really hard to sort of build out in a secure manner. The second challenge is the regulators don't necessarily know how people should be storing Bitcoin, so they can't push down best practices. So there's a little bit of education that has to happen there before regulators are comfortable with it. And so if a large institution wanted to go and plug Bitcoin in tomorrow, they wouldn't be able to do that because the traditional vendors, service providers they interact with don't have that feature enabled. And so it's going to take some time for startups to grow into larger companies, get regulated, and provide these services in a manner which will interface with these institutions the way they're used to having these third-party vendors integrate with them. You're seeing some companies build these in-house because they said, well, there's no vendors out there that work with our situation, so let's just build it ourselves. So Fidelity just made an announcement that they're launching their own custody product in a month or so.
Yes.
So it's just that there's no perfect fit on the market. It's just going to take time for the whole entire industry to grow and mature into what these institutions need. But it's a matter of time before it gets there.
Thank you. So I think that in the world of customers, there are very sophisticated ones and there's sometimes less sophisticated ones. Just go down the line. Who is your most sophisticated customer today that is relying upon you to help them? Just go down the line. I know that you all offer slightly different services, but who's your reference case?
Let's see. So we're very aggressive with when people are seeking to work with us. We're very aggressive in sort of our onboarding process and sort of our procurement of clients. And so we generally filter for clients that really care about regulations and that can pay for them and pay for that. And so what we found is generally our client base is either career CEOs, serial entrepreneurs that have run companies before that do understand that if they don't worry about regulations today, their company may not be there 5 to 10 years from now. So I think one reference client is a late stage venture fund we're working with. It's a tokenized fund. They're called Entre Capital, and they're probably a good profile for generally what basket our clients fall into.
Thank you, Matt.
I'd say that our most sophisticated clients tend to be the ones that are crypto from the ground up, who have been in that business from the beginning, who are not adding it as a new asset class or part of their offering, because they're staying abreast of new developments, both on the regulatory front and in terms of technology. And they understand that this is an evolving area, and they're generally pretty well informed and taking in a lot of information. Whereas folks who are approaching this from the traditional financial world, that face a steeper learning curve.
Thank you, Ben.
I think for us, we have kind of different sets of customers. So we're known for this wallet platform, which is used by many hot wallets on exchanges. Some of these exchanges, like you said, they've been around for a little bit longer in the crypto space, so they're a little bit more demanding from the technological side. They may want support for higher volumes. They may want lightning support for non-fungible tokens and everything like that. So that's quite challenging from the technological end. But at the same time, there are many larger institutions that we work with. Goldman Sachs invested in us, for example, that have already existing procedures that they have to do custodianship or to do business and integrations with. And because they're larger organizations, they have many more requirements for processes and security, and you could say that those are actually pretty sophisticated.
Great, thank you, Ben. So I, in my naive way, I was trying to figure out, 5 years out, where's the big opportunity? And that's what took me to this little chart in my head, where I said, if there's $150 billion of crypto assets today, there were more a year ago, and it might be more in the future, but it's right now 150 billion. There's $7 trillion worth of gold, 53 trillion of private equity, 75 trillion of real estate, 600 trillion of derivatives, of which 577 trillion are interest rate derivatives. So if we're going to tokenize something that's going to be big, you would think it would be the traditional assets. And I know that's TokenSoft's vision of the future. I don't know if the rest of you agree. But I'm just curious, if you went out 5 years and you were a custodian for tokenization and crypto, where do you think the weight of your respective businesses would be?
I think that you have to look even beyond custodianship 5 years from now. I think custodianship is at the base level, right on top of security and the technology that powers that, that makes some of this possible, tokenization and for mass market to come in and actually use these digital assets. I think that over time, custodianship will actually go down in terms of the fees that one can collect. So while it is true that I do believe we're going to be at $1 trillion, tens of trillions of dollars of wallets, so we have to keep improving our security around that. It's never really done. So today maybe you secure 50 billion, but then the price goes up. So you have to actually design it such that, for example, no address itself would hold more than a certain amount, so that you could individually secure different wallets. You have to keep working on adding additional forms of second factor. And so without going into the technicals, I think you have to keep working on that. But at the same time, it's the businesses on top of that, the ecosystem around the blockchain that custodianship can make possible, that is very interesting in 5 years.
Thank you.
Yeah, I take your point that there's a great deal of existing value out there that can kind of be tapped into in this field. And it's possible today to say execute a real estate transaction in Europe as a resident here. It's quite complicated. The question is, will tokenization actually simplify it and make it more universally accessible? Perhaps, but certainly what I'm most excited about in this space is the true potential of crypto native assets. And to the extent that the new businesses, like some of the ones we represent here, are unlocking that true potential for the long term, I think that's where the greatest opportunities lie, because we're still at the very early stages of the development of this ecosystem. And I think some of the most exciting things are the things we haven't even started to see yet.
Great.
Yeah, so when we started our business, it was like custody was one of those pieces that had to exist for us to be able to service our clients. So it's sort of like a feature in our platform. And I think as the industry does grow and more people start using services like BitGo, more and more applications are going to come to fruition where custody is sort of a feature and a building block that's necessary for them to do their business. So I think by the time we get like 5 years out, I think people are just going to be building layers and layers on top. At one point, our platform's going to build into these verticals. So we'll have a specialization for bonds, maybe a special product for real estate. And I think it's just, it's going to keep getting there. And as we get there, at one point, our platform will even commoditize further. And then custody will be further commoditized than that. It'll be further in the back. So that's how sort of how I see it maturing.
That's really interesting. And in fact, it makes me want to ask a question which just popped into my head, which is you used the phrase commoditizing, you used the phrase fees are going to be diminished. And in financial services, we're very familiar with this notion of the lead product. So, in retail banking, it's the checking account. You then are in the middle of the payment flow, the transactional flow of the client, and then you can cross-sell them the mortgage or the lending product or whatever, where you make all the money. You make no money off payments or very little. So in this space, do you view custody as sort of a lead product, or is it just a feature in an offering where something else is more important?
It's interesting. I've never thought of it that way.
I only just made it up. So.
I think it's sort of like I don't know, being a company and having a website. It's just something that you have to be able to service clients. It's one of those fundamental building blocks. It's like you have to, if we're going to start servicing users online, they have to have accounts. In crypto, they have to have you have to be able to custody their assets. So they have accounts in custody. So I think it's just one of those things that's going to be very commonplace in the future. There just needs to be there for a product to be able to come to fruition.
Yeah, that's certainly why I decided to start a business in this space, because I believe it absolutely has that kind of potential. Because it's both a necessary element, as Mason was saying, and naturally sits at the center of that transactional flow and has the kind of visibility and integration with adjacent systems that provides opportunity for it to expand into many other areas of business.
Yeah.
I think it's a building block. I think that sometimes it could be a lead product, but I think we know for sure it's a building block.
Yes. Though I think, Ben, it was also you that said, when we were talking about the traditional world, that the custodians often ring-fenced and not allowed to participate in other activities because of the double jeopardy issue of being, So anyhow, it's sort of an interesting thing, a conversation. Okay, last question, and then we're going to open it up. I've learned a lot already, but we've also got to discover what these people want to ask you. But I've got one last question. A lot of the people that watch these videos and are here today are actually entrepreneurs. And they're trying to figure out where they should place their time and effort and the business they should launch. So just going down the line, if you wanted new competition, what would you recommend it be? Where should the entrepreneurs in the room focus their efforts?
I think what we're seeing a lot of is that people are looking for ways that they can do something with their tokens or their assets on top of custody. So we're seeing a lot of people that, when you come in and you buy some Ethereum or Bitcoin, the first step is you say, okay, where can I put it safely? And then where can I put it in a compliant manner? And then after that, it's like, how can I earn maybe some interest on it? And then so you get into like lending. And then after that, it's like, how can I make, maybe I want to do some staking, proof of stake, get a little bit of rewards for that. And then there's an obvious one, which is everyone wants to trade and make some money out of that.
Okay, just don't lose my assets. Sorry, Matt.
I think at a macro level, and for the growth and health of the ecosystem in general, more products and services that allow crypto to be used in more contexts. It's still something that's not as accessible as traditional financial instruments to common people. So we'd love to see more things there. More specifically, in terms of our area of business, I think we need more innovation in the area of compliance. It's currently, to operate in the same way that banks do today, it's quite a heavyweight process to engage with regulators to feel confident in compliance. And I think there are opportunities based on the technological capabilities inherent in crypto to make things like proof of reserve and things like auditing much, much more efficient. And I think those efficiencies will lead to a lot more innovation in the space.
Thank you.
So as I said earlier, it's a space where it's very easy to break the law. So what I generally recommend to entrepreneurs looking to start a company in this space is go find the most expensive lawyer first that knows what you're talking about.
Maybe here at Shepherd Mellon.
Are they expensive?
They're really good.
Right.
Ask them.
So we're going to ask some questions. I think you can already see we're very lucky. We've got 3 of the world's leading minds in this area on the panel right here, right now. So please take advantage of it. Did you have a question? No? Well, let's ask.
That's fine.
Yes, please. Yeah.
So from
And I'm going to repeat the question for the television.
So from your institutional customer point of view, what are the product features they wish to have but still not available in the today's market?
So just repeating for the video, from your institutional customer's perspective, what are the features or capabilities that they want that you haven't yet delivered?
You want to respond or should I?
Okay, so there's 2 features that I think are still a little bit further out, but that I can see why they would want this. So the first feature that I think is commonly missing in a lot of digital asset or crypto products is that many of them are not built to be used by multiple users. So when you look at many of the wallets out there, many of them are single user wallets. You send or you receive and it's in a list that looks like a Microsoft Excel or whatever it is. But when you think about other things, for example, like trading, when you look at many exchanges, you sign up for an account, it has an email, and you can trade in the account. And what a lot of traditional traders have right now is that they can have combined risk. So for instance, you have a trading firm, and they have 100 million under management, right? They can assign 10 million to this trader and 10 million to that trader, and they can split up the risk. And as a whole, they can view their portfolio. And so that's the first feature that I think we're going to start to see this year or maybe next, because it takes a long time to build. It's very much all single account trading right now. The second thing that I think a lot of custodian customers have been asking for is that once you have the money in the custodian, you want to trade it. And right now, sometimes people end up just doing trades with many exchanges. So the challenge with that is that you have problems with the velocity of money. So say you store Bitcoin in the BitGo trust. You want to sell the Bitcoin for some Ethereum. And you found a good price on Bitstamp. Now you have to send the Bitcoin over there and wait for it to get confirmed, and then you can make the exchange and then send it back. So that's the first problem. The second issue actually really is that if you then chose to, why don't I just leave some Bitcoins on each exchange? So then let's say you have 100 coins and you put 10 on each. Now when the price is good on one of the exchanges, you can only take advantage of 10% of your funds. And I think that's something that lots of businesses want to improve on or get a better deal on.
Thanks, Ben.
So I think in terms of institutionals, one thing we keep noticing is everyone has completely different compliance requirements. So everyone has different steps and rules that they would like to follow, and we basically help clients enforce these compliance requirements. So this is something we run into a lot. So everyone is trying to follow the same rules, but they do it slightly differently. And so that's one of the interesting challenges we keep running into.
Great. Another question, I think there was one here, and I'll repeat it, so please.
So I'm a traditional commercial lawyer, and one thing that I've noticed is that isn't available with cryptocurrency is to be able to pledge them. You know, traditionally, a custodian, holds physical assets. They hold stock certificates, they hold promissory notes, and that's how you perfect a security interest in them. And usually there's a custodial agreement that allows, as part of a foreclosure process, the lender, if there's a default, to take custody and control of those assets. Now, if at this point you don't have programs that are available for multiple users, that would be a problem. But has anybody thought about, because this would seem like a pretty obvious use case and one that is really essential to making Bitcoin financeable or any sort of cryptocurrencies financeable, is to create some sort of a backbone for being able to pledge them. And so I'm kind of curious about what's.
So to summarize it for the video, the question is, has anyone or is anyone in the process of creating a backbone that would allow you to pledge assets that you put in custody, crypto assets that you put in custody?
Well, I think as Ben has said a lot about, and we're also great fans of, is multi-sig technology, which I think holds a lot of promise for enabling like more creative and more differently structured arrangements for that sort of thing. To have scenarios where, say, normally you transact on an asset with a certain set of keys, but that there are other keys that are held in escrow by other parties, which have obligations to ensure that those assets can be transferred or recovered under very specific circumstances. And to have that control extend all the way down to the technical level on the blockchain makes that a very real, it's not just an agreement on paper that these things will happen, but it's an actual mathematical capability to be able to execute on those actions. And so I think that's a very interesting area.
Anyone else?
I think this goes back to we could leverage some of what blockchain is really good for, which is being very transparent. So when you look at a blockchain, you can easily look up certain addresses and see what is the balance of those addresses. Then the next challenge is, how do we pledge the amount in the addresses, right? And there, you can sign a message using the key saying that I pledged X amount. But who's to know how many people have access to that key? And I think that's where it could be very valuable to have a custodian say, these are the assets that we control of the key, and they belong to this person, and we will hold them under certain conditions.
Yes, please.
This one is more from Matt. So in 2017, the flavor of the day was we really need a institutional grade custody solution to help the current institutional asset class move in, or institutional investors move in. In 2018, that was also a topic of consideration, but companies like Ben's have come in and created a solution like that. I think the need is broken down into two parts. The fact that you need something that's institutional grade, and the fact that it is a third party. I understand your solution is one that is designed for institutional self-custody. So how are you thinking about entering a market with that value proposition?
Okay, so sorry, just again. So the question's to Matt. Matt has created a custodial platform and technology which people can use to self-custody, and the question is, isn't the demand or need for third-party solutions where the custodian is a third party?
Yeah, there's absolutely a need for both models. One of the interesting things about crypto assets is that there is this opportunity for self-custody in a very real way that doesn't necessarily exist for other types of instruments. But our technology is applicable to both of these cases. Like we see institutions that are dedicated custodians, and their expertise is in custodianship for traditional assets, and they need the technology piece in order to be able to expand into crypto assets. But then also, I mean, some of the custodial banks that we talked about before, they're not only dedicated to that particular area, but they're entities like JP Morgan and Barclays and UBS and so on. And those entities need this capability as well. I think that just as it's a building block for all types of financial institutions to be able to maintain ledgers and account balances and so on, they will need some custodial capabilities as well to be able to handle these assets.
So you're basically assisting the traditional custodians into entering the space.
We also serve businesses that started on the crypto side, but yes, we do that too.
When these institutions have really like complex compliance requirements, tools like this are really easy. They plug in a lot easier because they don't have to change the processes. They can just change the tools they're using.
Other questions in the room?
I have a follow-up question.
Yes, please.
As it relates to third-party custody, would you trust Goldman Sachs holding your crypto when they'll steal $1 billion from Malaysia without thinking twice?
Well, that's a leading question. So let me just summarize it as how much trust would you guys have in traditional institutions to hold your crypto?
I believe Goldman Sachs specifically, so I'm going to let Ben take that.
No, it's an unfair question, Ben, but you're welcome to answer it.
I think if you ask me, I would distribute risk.
Okay.
That's how I would do it. And I think, like I said just now, I think the beauty of the blockchain and the Bitcoin and Ethereum is that everyone has the choice. And everyone has the opportunity to take it if they want themselves. But in order for it to be widely available to everyone, to the man on the street, you have to have a service that you can trust others with.
And that's actually a very sophisticated answer, because in traditional financial services, the government insures and backs us to certain extents when we go out and give people our money. But I'm assuming to date, crypto custodians are not insured by government entities. Am I right, or is that not right?
To my knowledge, they are not insured by government entities.
Yes. So any other questions? So I have one last question. Yes, please, then.
There are AA rated insurers that sort of gave this space stamp of approval. Right? Lloyd's of London, for instance, Chubb have sort of underwritten policies against crypto assets. You talked a little about that. I think it's huge.
Okay, so I think the observation is that the insurers are beginning to be prepared to insure these assets.
Sort of a transfer of risk.
Okay.
Okay, so this is an area that I'm very passionate about actually. Because, well, I wouldn't say I'm super passionate, but I've been working on this. We have been working on this insurance problem for very long. And I think that the way I would respond is we need more transparency in terms of what the insurers are really insuring. So there are many companies out there that say, oh, I have insurance. So I think the question thing to ask is, how much are you insured for? Are you just insured for 5 million out of the 100 million you hold? What is insured? Is it the hot wallet or the cold wallet? And under what circumstances are they going to pay out? Many people, to make things look a bit more extreme, say the insurance may be just typical cyber insurance, and that may not really cover theft or employee theft or certain hacking or you really have to look into the specifics of the insurance policy.
So I got the sign that we needed to wrap up. So I want to ask one last question, which is troubling me because I don't understand it. The other one was this one of the rollback and the elimination of a asset altogether from the immutable record. And I think it's something I've been very worried about because it looked like this community has turned on itself and eaten the notion of immutability and trust by demonstrating that they could unravel or roll back a blockchain, which is of concern. But the other one is this. This is software. So to use Ben's example, when we have gold, if we divide the gold in half, we have 2 pieces of gold and they're worth half as much. But with software, when we copy the software and we then enhance the software, the first piece of software may become worthless. And so in my head, that's the fork, right? If we fork an asset and all the value, the community, the activity goes to the new fork, the old fork could be abandoned. But if you're the custodian, you might be holding something which overnight becomes worthless. And again, I'm wondering, is that just bad luck on behalf of the person that gave you the asset? How does that work? Just help me understand, if the asset forks and you're the custodian for it, how does that affect you?
Well, I think in some cases the custodian may be in a position of having to take a position on it, which I think is potentially very uncomfortable. But certainly there are asset classes today which are in custody and can vary in value or even become virtually valueless. So I imagine there are some established guidelines around that. But I think with crypto assets, there's this added degree of uncertainty where sometimes it's not exactly clear what's happened. Like, has the asset been lost? Is it gone forever? Has it been reappropriated? Is it potentially reappropriated? Is someone holding a key somewhere, but we're not sure? So I think there's a bigger gray area that will need to be addressed.
Okay, thank you.
Yeah, I think so again, there are different regulatory structures you can use to do custody, and the different styles do have different styles of protection built in. So for one style, there may be minimum capital requirements. You may have to get insurance. So if anything like this happens, hopefully it can get covered. If you're the structure is a bank, maybe there's FDIC insurance, but it doesn't go that high. So there are protections built in, but at the same time, from our perspective, we build in technical protections. So if the rails and infrastructure go away tomorrow, there should be the ability to reissue the asset and get back up to normal operations by some manner. So,
okay. Yeah. Well, thank you very much. Let me, I don't want to end on such a trivial tactical question, so let's just go down the panel. If there's one big thing you want to leave behind, either about your company or about the space, to the audience and to the television audience, what is the one last thing you want to say?
I'll go last here.
Okay, I guess it's maybe not the most hopeful note, but I think I'd have to reinforce just what a rich and complex and multifaceted area this is, and will continue to be. That it's not a direct translation of existing custodianship, nor is it something completely separate. I just attended a workshop earlier today by the folks at Blockchain Commons, which is a day-long seminar just teaching people about all the different ways to do custody at more of an individual level even, ranging from different types of wallets and software to operational security protocols to how you stamp your recovery passphrase in a piece of titanium. So there's really a lot going on here, and it's an area that's worth paying attention to.
Thank you, Ben.
I think it's, what I love building are products which can really be used in ways that you've not necessarily figured out before. So we recently were working together with a lot of members of the community on a project called Wrapped Bitcoin, WBTC, which takes a Bitcoin and tokenize it on the Ethereum blockchain. And that we initially thought would be popular with decentralized exchanges, because right now decentralized exchanges exist on Ethereum only and they can't trade Bitcoin, so they wanted to be able to trade Bitcoin, which is why we did this for them. And then as it turns out, over time we started to see lending platforms that wanted to take collateral in Bitcoin as well, and then this is something new that happened out of that. It's almost as if there's a word for it, but it's escaping me now. It's kind of coming out of being able without you having necessarily always seen it. It's what I really enjoy about working on platforms and building an ecosystem this early.
Thank you. And the final word?
Yeah, so build something cool, go get an expensive lawyer, stay out of trouble.
Okay, thank you very much. So let's do a round.
Emergent. The word
emergent. Not serendipitous. So let's have a round of applause to the panel.